Could your dream of owning a home turn into a financial nightmare? In this video, we're diving into the real estate market's big challenges. Goldman Sachs, a major player in finance, warns that we're close to a housing crisis that could be even worse than the 2008 disaster.
Fed keeping interest rates steady.
Fed believes that they have likely reached the peak on rates in the current cycle, and that they will begin cutting sometime this year, certainly not looking like March.
The committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Prices are rising, homes aren't selling like they used to, and mortgage rates are at their highest in years. Whether you're a homeowner, a potential buyer, or just curious about the state of real estate, this video will change how you view the housing market. Get ready for a journey through the highs and lows of real estate, a story where economics meets personal dreams, and the outcome is still uncertain. Current real estate versus the 2008 crash. Let's go back to 2008. That was when the housing bubble burst. It was a total disaster that shook the economy to its core. Why did this happen? Well, it's a bit like a perfect storm. First off, let's talk about subprime mortgages. Banks were handing out loans like candy at a parade, even to people who weren't likely to pay them back. These risky loans got bundled up and sold to investors. But when people started missing their mortgage payments, the value of these investments crashed hard. A lot of homeowners had adjustable rate mortgages. These start with low interest rates, but then the rates jump up. When that happened, tons of people couldn't afford their payments anymore. Let's not forget the lack of rules. Before 1999, there were laws like the Glass-Steagall Act that kept commercial and investment banking separate. But that got scrapped, and suddenly, banks were taking bigger risks without enough checks and balances. People lost their homes and their jobs. Businesses were struggling to keep the lights on. The financial system is all connected, so when huge U.S. institutions started failing, it sent shockwaves around the world. Governments had to step in big time. In the U.S., they rolled out the Troubled Asset Relief Program, TARP, to help struggling banks. The Federal Reserve slashed interest rates and pumped money into the economy. After the dust settled, everyone realized we needed tighter rules for the financial sector. So in 2010, they introduced the Dodd-Frank Act, which was all about making the financial world more transparent and accountable to avoid another 2008-style disaster. The 2008 housing market crash had a huge impact on U.S. housing prices, leading to a decrease in prices. Before the crash, housing prices had increased rapidly. Data from the S&P CoreLogic Case-Shiller U.S. National Home Price NSA Index shows that housing prices dropped by 27.4% from their highest point in 2006 to their lowest in 2012. This decline was more severe in states like Arizona, California, Florida, and Nevada. In these states, housing prices had increased the most before the crash and subsequently fell by more than half from their peak values. But the real estate market today might be headed for an even rougher ride. Stay tuned to find out why. In today's market, house prices have skyrocketed, nearly doubling what they were back in 2008. The housing market is growing because more millennials are looking to purchase their own houses. Also, with more people working remotely, they can choose to live anywhere. This has increased the number of people wanting to buy houses in suburban and rural areas. This is where it gets weird. We're not making enough new homes, but the ones we have aren't selling fast. It's a strange problem. Lots of people want to buy houses, but the houses out there aren't moving. And here's a big red flag. With mortgage rates over 6% now, for the first time since 2008, fewer people want to buy homes. Sales have dropped a lot, almost 20% less than last year, says the National Association of Realtors. It looks like house prices might just start falling big time. Stick around, because what I'm about to reveal next will change how you see the housing market forever. Picture this. It's the mid-2000s, and buying a house is as easy as picking out a new pair of shoes. Credit's flowing like a river, and everyone's jumping in. Then, 2008 hits. The market crashes, and it's chaos. But we learned from that mess. Lending got stricter, no more easy loans, and people getting mortgages today are less likely to default. Sounds good, right? But what if I told you that despite these safeguards, we're still skating on thin ice? Fast forward to today, the game has changed. Back then, adjustable rate mortgages were the ticking time bombs. When rates reset, payments skyrocketed and people couldn't keep up. Now, we've got mostly fixed rate mortgages. So even though rates have doubled, those monthly payments, steady as a rock. Sounds like we're safe, doesn't it? But here's the catch. Stability in payments isn't the whole story. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Let's talk equity. Today, a lot of homeowners are sitting pretty with equity in their homes, in contrast to 2009, when a quarter of homeowners owed more than their house was worth. Today, even though equity dipped a bit, the average homeowner is still way ahead compared to 3 years ago. That's a cushion, a safety net. But here's the million-dollar question. Is this net strong enough to hold if things go south? And what about renting? Rent prices have risen by nearly 30%. If you can't afford to buy, you're squeezed even more. Meanwhile, we've got this crazy situation with a 10.4-month supply of new houses just sitting there. The most since 2009. And get this, we're building more than we need. It's a housing surplus in a market where prices are sky high. But wait, there's a number that will really make your head spin. The median new home price is around $438,000, but the average earnings is not nearly enough. The price-to-income ratio is now at a jaw-dropping $16,035. The highest since those dark days of the Great Recession. Simply put, houses are too expensive for most people's wallets. The S&P CoreLogic Case-Shiller Index, which is like the housing market's pulse, only rose by 15.8% in July. It sounds great, but it's actually a sign of slowing growth. And Zillow? Their numbers are showing a dip for the first time in 10 years. We're witnessing one of the sharpest U-turns in housing growth in history. But every story has more than one side. Let's hear what the experts are saying. Mark Zandi from Moody's predicts a price correction of 0 to 5% in the next year. That's not a crash, but it's not great news either. Aaron Brown, formerly of AQR Capital Management, sees similarities with past bubbles, but isn't pressing the panic button yet thanks to rising rents. Roger Ashworth of Goldman Sachs acknowledges the solid ground we're on, but affordability? It's a whole different challenge. It seems like the experts aren't in full agreement, so what should you be watching out for? Goldman Sachs is sending out a warning for cities like San Jose, Austin, Phoenix, and San Diego. These markets are like pots on the verge of boiling over. The interest rates are going up, with predictions of the 30-year fixed mortgage hitting 6.5% by year's end. But is it all gloom and doom? Or should we look at the other side of the coin? As mortgage rates crossed the 6% mark, the impact was immediate. Buyers are hesitating, slowing down the home buying process. In Austin, homes are now on the market for an average of 68 days. However, local realtors insist demand is still strong. So is the market really ice cold, or is there still some heat left? New York and Chicago are bracing for a slight dip in prices, under 2%. But flip the coin, and you've got Baltimore and Miami, where prices could actually climb. Cities that have been playing a high-stakes game with their real estate prices, San Jose and Phoenix, might face drops of over 25%. But it's not all smooth sailing. There's a challenge that's hitting homebuyers hard. Affordability is the word on everyone's lips. And let's be honest, it's tougher out there for buyers than in the pre-2006 crash days. The Atlanta Fed's alarms are signaling that buying a house is getting tougher on the wallet. Prices could inch up by about 1.8% by the end of this year, and maybe another 3.5% by the end of 2024. So what's driving this market? Is it the same old story, or is there a new twist? Unlike the 2008 crisis, where risky mortgages and a glut of homes were issues, today's high prices are born from a lack of available housing. Factors like slow construction, regulatory barriers, and the aftermath of COVID-19 have all contributed to this shortage. Add to that the surge in demand from millennials hitting the prime home buying age, and you've got a market that's tight and getting tighter. But this isn't just a story of scarcity. there's more at play here. The low interest rates of the past decade, now rising, have a dual impact. On one side, they've let homeowners refinance to incredibly low rates, making them reluctant to sell. On the other hand, higher rates are now pushing potential buyers out of the market. The result is a standoff where sellers wait for high prices and buyers hope for a drop. So, what does this mean for the average homeowner or potential buyer? Let's find out. Today's homeowners are more financially stable. They're not the risky borrowers of the past. This stability, with significant equity from rapid home value appreciation, gives them a buffer against market downturns. So even if prices drop, many won't be immediately underwater, unlike during the Great Recession. But could this strong equity actually be a double-edged sword? While rising home prices and built-up equity sound great, they bring a real challenge for first-time buyers and lower-income households. With prices and mortgage rates climbing, we're potentially looking at a housing affordability crisis. Now, here's where the plot thickens. Despite these warning signs, the big economic collapse everyone braced for in 2023 didn't happen. Why? Because our job market was like a superhero, keeping the economy afloat with strong employment and wages. But don't let this fool you. The danger isn't over, it's just lurking in the shadows. As we step into 2024, the economic weather is changing. Inflation is still stubbornly high. People are borrowing more, racking up debts, and even credit card offenses are at their highest in over a decade. So, what's the deal with the housing market in all this chaos? Mortgage rates are a roller coaster that's forgotten how to go down. If a recession hits in 2024, as some predict, don't expect these rates to give you a break, and even a mild recession won't do much to lower these rates. This is where the story takes a dark turn. High mortgage rates combined with pricey homes could push many potential buyers right out of the market. In 2008, the housing market crash was a nightmare, but this time, it could be even scarier. Why worse, you ask? Imagine a world where even with a steady job, buying a house feels like a distant dream. That's the reality we might be facing. The housing market isn't just about numbers and rates, it's about people and their dreams of owning a home. And when those dreams are threatened, the impact is more than just economic, it's personal. So we've talked about the looming clouds over the housing market, but not all experts agree that a total crash is coming. In fact, many see a correction rather than a collapse. Danielle Hale from Realtor.com believes that the economy and job market are holding up like pillars, supporting the housing market. She's not expecting a housing crash in 2024. She reasons that a crash would need an imbalance, like a seesaw with one side way heavier than the other. But right now, that's not our scenario. There's still a strong demand for homes, and supply isn't catching up fast enough to tip the scales. But there's still potential bumps in the road. If the job market hits a rough patch and pushes us into a recession, homeowners might need to sell their homes, increasing supply and possibly lowering prices. And there's another worry: commercial property values. If they continue to drop, homeowners might feel the pinch in the form of higher property taxes. So what's next for the housing market? Well, experts are betting on a reset. They believe that as things cool down, mortgage rates will start to fall from their peaks. This, along with slower home price growth and the constant demand for homes, will likely bring buyers back to the market. But what about the supply side of things? Homeowners who got sweet mortgage deals during the pandemic are likely to stay put. And with people living longer, homes aren't hitting the market as frequently as before. New home construction is trying to catch up. It's helpful, but not enough. So, what should you do if you're looking to buy a home in this challenging landscape? Well, it's a bit like a chess game, where every move needs to be calculated. For starters, the current market might push some buyers to look beyond the bright lights of big cities. The suburbs or smaller cities could be the new targets with their more budget-friendly options. It might also mean rethinking priorities, maybe a smaller house or fewer fancy features. But the market isn't as cutthroat as it was earlier in the year. This means buyers might not have to duel with as many competitors for a home. And who knows, you might even snag a house for less than the asking price. But what about those who aren't ready to dive into home buying just yet? What should you be doing in the meantime? Think of this period as your training mortgage. Bulk up your savings. Every dollar counts. Strengthen your credit score like you're building muscles, and do your homework on towns and neighborhoods. Also, keep an eye on the market trends. Remember, demand tends to spike when mortgage rates cool down. If rates drop enough, we could see a rush of buyers, and with the current light housing inventory, this could drive prices back up. That's something you don't want to be caught off guard by. As we navigate this uncertain landscape, keep an eye on those wobbling blocks. The story of our economy and the housing market is still being written, and the next chapter could be a game changer. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below with your thoughts.